My topic today is qualifying expenditures for flow-through and tax credit. Quick overview of the agenda. Five different classifications of mining expenditures: CEE, CDE, CEDO, COGB, and free. I'll then get into specifics regarding the tax treatments of environmental studies, community consultation, and feasibility studies. Lastly, I'll talk about the federal ITC and the BCMETC. As most of you know, the mining is a high risk and capital intensive industry. The federal and provincial income tax system and most provincial and territorial mining tax system recognize this fact. So they allow mining companies to recover much of their capital investments before paying taxes. The income tax rules also recognize the cyclical nature of the mining industry. So they provide a generous loss carryback and loss carry forward rules. So often a decade or more passes before a company can begin commercial production, if you hit something. The flow-through share regime allows companies to renounce to shareholders a tax benefit. So it makes the shares more attractive and allows the mining companies to raise capital more easily. An overview of a typical life cycle of a mine. The first stage is exploration, which is very high risk. The second stage is development, which is highly capital intensive. Third stage is operations, which is the actual production, waste treatment, marketing, and then the transportation of the resource that's found. The last stage is reclamation, which is basically leaving the site better than when you found it. So the five different classifications for resource expenditures under the Canadian Income Tax Act are CEE, which is Canadian Exploration Expense, CDE, Canadian Development Expense, CEDO, Canadian Exploration and Development Overhead Expense, COGP, Canadian Oil and Gas Property Expense, and lastly, FREE, which is Foreign Resource Expense. The definition of CEE is to determine the existence, location, extent, and quality of a mineral resource in Canada. And this includes prospecting, rotary, diamond, percussion, and other drilling, geological, geophysical, or geochemical surveys. It also includes trenching, test pits, preliminary sampling, and pre-production. And of course, all CEE qualifies as flow-through expenditures for flow-through purposes. CE does not include any Canadian development expenses, which is CDE. It also doesn't include any expenses that relates to a mine that came into production in reasonable commercial quantities. Reasonable commercial quantity means first day of first month of consecutive 3-month period where the mill first operates 60% of its rated capacity, provided the mine is a sole source of ore to the mill. Reasonable commercial quantities can also kick in if the mine has been in production for an extended period of time, but has operated below 60% of the mill's capacity. CE also does not include the acquisition cost of a depreciable property, and also doesn't include finance fees or share issue costs. CDE, which is Canadian Development Expenses, includes the acquisition cost of Canadian resource property. It also includes the cost of mine shaft, main haulage way, or similar underground work incurred after the mine has gone into commercial production. For the oil and gas sector, certain drilling and completion costs related to first discovery well, they're normally classified as CDE, can be treated as CEE, and therefore eligible for flow-through expenditure. So CEDO is Canadian Exploration and Development Overhead Expense. So they include any CEE or CDE that relates to administrative or management fees, and also in respect of salaries and wages of employees whose duties are not 90% or more directed toward exploration or development activities. So for example, let's say you're paying a geologist on a salary basis, and they spent 60% of the time on geological work and 40% on administration. The entire salary cost does not qualify because 90% of their time has not been spent on exploration activity. So that goes without saying that CEDO cannot be renounced as a flow-through expenditure. COGP is Canadian oil and gas properties expense. They're generally the cost of acquiring oil and gas wells, an interest or right to explore, drill, or extract petroleum or natural gas. The last category is free, which is foreign resource expense. Free are expenses incurred in acquiring, exploring, and developing a foreign resource property, owned or intend to own by a Canadian resident. Free can also consist of an enforceable right to a royalty or any future production from a foreign mineral deposit discovered. So moving on into more details about the CE general expenses. What's also considered CE are drilling, metallurgical testing, and associated costs incurred to confirm resource included in the 43-101 reports. Just to remember that the actual cost of paying someone to do the 43-101 reports does not qualify. So be sure to separate these costs out. So from my experience dealing with a CRA auditor is that they tend to strike out any expenses that says 43-101. So just be aware of that. What's also out is capital costs of depreciable property, such as road drilling, equipment, construction of housing facilities. Also out is the overhead expenditures, and also scoping study costs that relate to assessments of mine development options or profitability of developing deposit into a mine are also out. Moving on to environmental studies. What's considered CE is environmental assessments undertaken by a taxpayer to meet a legal or informal obligation under the terms of permit. So under is the operative word. What's also in is the environmental assessments undertaken to meet a legal or informal requirement to obtain a permit will also qualify, and obtain is the operative word. This doesn't qualify until the recent March 2015 federal budget, when the government decided to announce some new measures to support Canadian mining. So since the announcement, the environmental assessment to obtain a permit costs qualify. What's also in are other assessments conducted at the discretion of a taxpayer, such as environmental sampling, monitoring in relations to an exploration activity. Also in are targeted environmental assessments, such as vegetation, fisheries, and water assessments. That's part of a specific exploration activity. What doesn't qualify is a general baseline. It's moving here. It's moving too fast. Okay. What doesn't qualify is a general baseline environmental assessments undertaken prior to carrying out a specific exploration activity. What this really means is that a decision has to be made to carry out a specific exploration activity first before spending of baseline environmental assessments. Expenses can qualify. So one of the ways to prove this is the management meeting minutes. This is a bit of a tricky piece because you don't want to make a decision to carry out a specific exploration activity unless you get an assessment to determine the environmental impact first. So the CRA is saying that in this instance, expenses don't qualify. So it's a bit of an unfair situation. Moving on to community consultation. What's in is consultation undertaken to meet a legal or informal obligation under the terms of a permit. So this is similar definition to environmental studies. What's also in is consultation undertaken to meet a legal or informal obligation to obtain a permit. So like environmental studies, it didn't qualify until the March 2015 federal budget announcement. What's also in are costs of negotiations to secure surface access for exploration purposes beyond the requirement of a permit. What's also in is costs of negotiations with local communities, such as the First Nations bands, to secure certainty with respect to exploration expense beyond the requirement of a permit. They'll only be considered CEE when they're incurred in relation to exploration process and not for a broader purpose. Other community consultations undertaken by a taxpayer can also qualify, such as work for exploration process only and exploration and mining processes only. Okay. So what doesn't qualify for CEE under community consultation is costs relating to assessing community attitudes or community information program undertaken prior to a decision to explore. So this is what I've said earlier about under environmental studies. For feasibility studies, what is in is planning for studies relating to the conduct of an exploration activity or some part thereof. What's also in is physical and chemical assessments related to a deposit with the objective of informing a decision whether to undertake more advanced exploration at the site. Also assessing of physical and chemical characteristics of the deposit to assess its potential as a commercial deposit are also in, so they also qualify. What doesn't qualify is preliminary planning for a potential exploration activity undertaken prior to decision to explore. Again, this is similar to environmental studies and feasibility studies. Also, assessments of mine development options and profitability of developing a deposit into mine are also out. Okay, so switching gears a bit, I'll talk briefly about the federal tax credit called the pre-production mining expenditure tax credit. The federal pre-production mining expenditure tax credit is actually already phased out. So I won't get into it too much. Before 2013, it was 10%. In 2013, it was 5%, and after 2013, it went all the way down to 0. So it's been completely phased out. And also for development expenses, the federal ITC is also being phased out. It's 4% for 2015, and it goes down to 0 after the end of this year. The last topic is BCMETC, which is the British Columbia Exploration Tax Credit. The BCMETC is a 20% refundable tax credit, meaning a potential cash refund. It came into effect August 1st, 1998. It's scheduled to expire on December 31st, 2016. Eligible taxpayers may receive a cash refund for any credit claimed in excess of taxes payable. There's no carry forward or carry back provision. There's also an enhanced rate of 30%, going from 20% to 30% if the exploration work is done in the prescribed mountain pine needle affected areas in BC. And if you go on the website, there's a map of it, and most of BC does qualify under the enhanced rate of 30%. Eligible individuals can claim the BCMETC if they're prospectors. So can corporations, as of April 1st, 2003, so can active members of partnerships conducting grassroots exploration in BC. Qualifying expenses must be incurred after July 31st, 1998, and incurred before January 1st, 2017. It must be for the purpose of determining the existence, location, extent, or quality of a mineral resource in BC. So, typical definition of under CEE. And also must be in a course of prospecting, carrying out geological, geophysical, and geochemical surveys, as well as drilling by rotary, diamond, percussion, or other methods, as well as trenching, digging, test pits, and preliminary sampling. More. Okay. So for goods and services that are all or substantially all, meaning 90%, must be provided in BC if they claim the BCMETC. They must be reasonable in circumstance, and any BCMETC claim amount must reduce the CE pool. Additional information on the BCMETC can be found in the bulletin CIT 006, and you can find that online pretty easily. Expenditures that do not qualify for the BCMETC are CDE expenses, CEDO expenses, acquisition cost of capital assets, as well as flow-through renunciation expenses also do not qualify. Okay, that. A few administrative matters on the BCMETC. Corporations must complete the Schedule 421 of the T2 to apply. They must be filed at the same time as the T2. The form must be filed within 36 months after taxation year in which the credit is claimed. As mentioned before, the tax credit must be deducted from the CE pool. And lastly, on the Schedule 421, there's some information that must be reported on the form to make the claim, such as mineral, project name, division, and title, and also to break out the categories by prospecting, drilling, trenching, etc. I didn't mention here, but if you're making exploration expenses in Quebec, there's also cash refunds similar to the BCMETC that you can claim.